What's up, guys? Welcome to another Market Radar podcast. We're recording this one on Thursday. As of Thursday, year to date, we've got NASDAQ up 10.91%. Quite a move off the lows, but don't get FOMO. Just keep everything into perspective. Realize what environment we're in right now, and also realize that NASDAQ can move 40% and be back where we were just a year ago. So to get back up to highs, that's a 40% move that can be taken advantage of if the environment calls for that. So let's take a look at the calendar for next week. We've got FOMC next week. That's very important. Wednesday. That's going to be the talk of the week. We'll also put a video out for you guys on what we're expecting from FOMC. We'll also talk about it a little bit today, but we'll have another separate, more in-depth video on that. And then we also have unemployment coming out on Friday. That's going to be very important as well to see if the Fed's actions are really doing anything, which so far it's not looking like it's doing much. They can't really stop the market, as we've seen from the GDP print this week. So speaking of that, Gamma, you want to take that?
Yeah, so let's talk about GDP this week. Obviously, we have another positive print on a real basis, quarter over quarter, lower than the prior print, but we're still in the positive. Now, this is well above the recessionary area that we were experiencing last summer. So again, GDP up, markets liking that. Obviously, the Fed doesn't like that, but on the markets, they love it, right? It's very simple. Growth rebounding is or will put us into a positive risk regime at some point. Into a risk-on regime, right? That's going to happen. Inflation can be high as long as it's not hyper. A positive growth regime will be bullish for the markets.
And I don't want to toot our own horn. Well, I mean, you called it in the GDP video that was released the day before. You called that markets are going to be rallying into GDP and on the hopes of a soft landing possibility, which we know is not possible. We're not going to get a soft landing.
Right, we'll talk about that today.
Yeah,
we'll go over
the
that.
recession will possibly come later than what people are expecting.
Yep. And let's go over ES though, because this again making major headlines here because we broke some artistic drawing, right? So we cracked that.
Artistic technical analysis has been broken this past week.
Yeah, triangles and pendants, the whole nine, right? We're just peaking above. Everyone's getting all excited and bullish, right? Not that we're not, but we have to understand the system will lead us, right? Aries will lead us at the end. The system is a part of Aries. DDAP is a part of Aries. Both will have to confirm. Obviously, the market's up on the GDP print, like we said in the video the night before. We believe that the market's going to move on a positive GDP print, which it did. And the primary reason behind that, again, is going to be this idea that everyone on the internet or on FinTwit that's dealing with markets on CNBC, the whole nine, they're looking at this and they're saying one of two things. Either this is bullshit, the recession's coming, I'm shorting this, right? Getting max short, the whole
right. I'm actually seeing a lot of angry short sellers lately.
Right. And the other one is going to be we have a soft landing. And I think personally, again, I always want to specify when we record these podcasts and this content, this is in addition to Aries or our entire environment that we have, the market radar environment. This is not a thesis for you guys to build positions off of, because my thesis or my narrative is built around the system, DDAP, and ultimately Aries. So whatever Aries says is where my narrative is going to go, right? So as Aries builds one way, my narrative is going to build that way. And that's just me telling you that I'm not sitting here basically glued to an opinion because I believe something's going to happen. Nonetheless, what I am seeing though is this shifting growth, right? And we've been talking about this adamantly the last couple of weeks. And this shifting growth is going to get people to believe that a soft landing is possible. And again, we've covered this adamantly, where a soft landing is impossible. Okay, it's not possible, it's impossible, because the idea that you get inflation under control without price destruction is just not going to happen, right?
It's a fallacy. It goes against all rules of economics.
Right. Literally, we go back in time. inflationary peaks above 5% are followed by unemployment spikes. Okay, this is history. Now, this is the problem that everyone falls into. What I am saying right now is what I've seen, the data points I've observed. People will take this idea and say it's guaranteed to happen again. The difference is, could there be some type of weird situation where inflation comes down, unemployment doesn't rapidly break out? Yes. Is that a soft landing? No, because at some point the recession is going to come. You don't go from 0 basis points to almost 500 basis points in a little over a year and nothing happens. The bond market's already, we look at the Fed forward curve, right, where the Fed is expecting, where the Fed funds rate is expected to go in the next year. That's already pricing in Fed rate cuts, which again, Fed's not going to cut rates unless there's a recession. So that's already, and the yield curve, again, inverted, pricing in an upcoming recession. It's not the inversion of the yield curve that's the issue. It's the reversion, right? So it's when the yield curve reverts and the front end drops down below the back end, right? That's the reversion
and
process.
We could stay inverted for a lot longer than people expect.
Right.
It's possible to stay inverted for another 2 years. And in that time, there could be a move in equities.
Right. And I think that's where we're going to take this right now. So the idea of a soft landing will fuel itself until the soft landing is disproven, right? This is what's going to happen. Think of it like stepping stones in the sky with no support, and eventually the last block gets pulled and you fall to earth. That's what's the most likely potential, or I should say, that's the most probable scenario based off of what we're seeing right now with the data that's coming in, and again, what the system is signaling towards us. That at some point here, we're going to get some risk trigger, risk on, right? And a lot of people are going to not understand what that means. Meaning, okay, either they're going to long with the idea that the soft landing is here, with confirmation, or they're going to try and short it as a fake out. And obviously, we're not going to go against our own system. But long story short, it's if we do see a risk on pivot and what we would call a bull market, even though it might not be long lived, again, it could only be 6 months, it could only be 1 year, could be 3 months. We don't know, right? That we're not in the business of telling you, yeah, SPY target of 420.69 cents. Like that's fucking bullshit, right? We're not going to tell you that. But long story short, if we do get the bull market, could be 3, 6 months, 1 year, whatever it is. The longer that bull market runs, if and when we get it, right, the more and more people are going to buy into the idea that shorting the market's wrong, and a bull market rally is now a new bull market, and the idea of a soft landing is cemented. And out of nowhere will come the recession.
Right. And those same people are going to be the ones that ride the wave all the way back down.
Exactly. And we can tell the bond market is a little uncertain of what's going on. Let's pull up ZB real quick. Right. So let's look at the last two CPI prints. The November released in December and the December released this month, right? Long bonds are literally trading at or below those daily closes of those CPI days. So even with an improving CPI, consecutive improving CPI reports, the bond market isn't running. If the bond market thought a recession was here, the bond market would be moving up. At least we'd be at Momo. We'd be talking about, oh man, we might get that bullish trend pivot. This is actually looking like it wants to break down. I mean, we're still holding mid-vamp.
They're essentially not believing that inflation has peaked.
That's another way to put it, yes. And now, so for those that don't know and that are watching, the white line is the mid-vamp. These are the volatility-adjusted market projections. I'll say that again, volatility-adjusted market projections. They're telling us where price can move in a relative short period. The mid-vamp level is what we would consider that momentum pivot, right? Once price is above that mid-vamp, it can trend higher, even though the main trend's bearish, right? It's a bearish trend, obviously, by the red background. It can glide higher. Momentum is, at least in a very short-term, bullish. So for us to see long bonds fall long into the bond curve, or long rates rise, we're going to need to see the long bonds get back below that mid-vamp level and start breaking down to really ignite that bearish momentum again. And when that happens, higher rates, it may shock equity markets. It may not, because of the fact that growth is on the mend. Now, growth, as long as growth is on the mend, the improving inflation numbers will be met with less concern.
Hmm.
of the idea of a
So
recession. Because
growth is really the deciding factor in
right,
whether or not equities run or not.
right. Because remember, at the end of the day, growth is the deciding factor of risk on or risk off.
Exactly. Yeah. So
So let's
I
go
want to
ahead.
talk about the latest jobs numbers and GDP numbers coming in strong. Is that what the Fed wants to see, and how is that going to affect their decisions?
Okay, so let's bring up the Fed funds or the Fed fund, excuse me, the EFFR, which is the Fed funds rate as of right now, which is 433 basis points. So let's look at where the terminal is expected. You can see on the yellow line here, it is the yellow dotted line with white term. This is the terminal, 491 basis points. Okay, so we're expected to go up about another 60 basis points over the next few meetings, and the Fed's expected to pause after that, or at least marginally start cutting rates. But again, we're going to clarify that in a second why we don't see that happening, and the bond market isn't really pricing that in. But let's get into the terminal. The terminal is now lower, and it has been for some time now, than the 2006 peak. Okay, this is the worst inflation in 40 something years, and the terminal is less than 2005, 2006. So that's something, right? This is a very unique situation. Now, does the Fed want to surprise equity markets to answer your question? The Fed has a very unique way of basically playing the cards that they've dealt themselves. Okay, they've hiked rates so fast. They've basically front loaded. They front loaded the curve so hard from 0 to 400 basis points, almost going to be 500 basis points in a little over a year. That they have two options now. They can hold rates and just wait for inflation to fall, and wait until you get that deflationary event, right, where inflation really falls off a cliff. Because what happens when you hold rates up for a long, it's not. I've said this many times. It's not the rate, but it's the time at which the rate is there. So the longer the Fed holds rates, the more damaging it will be to the economy. So the Fed is not the idea that the Fed's going to bring rates up to 4.9% or whatever, and then start cutting them aggressively is doesn't make much sense unless they are certain that inflation is cured. Okay. So the Fed's also not going to go super hawkish anymore. This was their super hawk move. So they front loaded the curve enough where they don't need to scare equity markets anymore. So I'll give you a scenario. Inflation is sticky, right? It's in that 6 to 7 range, and it's just it starts bouncing, right? We're seeing copper bounce, we're seeing some other commodities bounce.
Right,
So
and
listen,
well, we're also just seeing GDP numbers high. The jobless claims numbers are the job market is still hot.
right.
So isn't that going to prompt them to be more hawkish and want to raise rates more?
Right, but what's more hawkish, right? Because they front loaded so hard. The days of 75 basis points and 50 basis points, in my opinion, unless inflation just gets out of control, are over. Now it's all about like they can sit here and do 25 basis points every meeting, every other meeting, and just ride it up until inflation is done.
Aren't they worried about chasing inflation? If we do get a return of inflation, get back up to the peak, aren't they going to be worried and start pumping out 50 basis point hikes again?
Well, the whole point is by them front. So this is what look. The Fed's not going to want to scare equity markets we've been saying. We've been saying this. The Fed's not in the industry of scaring markets. They've actually done a really good job this year at buoying the markets by basically coming in dovish on the lows with the Fed meetings and whatnot, letting the markets rally, having the speakers come out all hawkish. Right, the market drops. It's almost like it's balanced. Right. So if inflation is really an issue, the Fed is obviously going to have to hike more. But they've bought, think of it like this. If we look at where the rates have gone in this period of time and where they've gone historically, it's the worst inflation we've seen in a long time on a rate of change basis. I understand. But if you look at comparative like peaks to trough, right, of these inflation of these rate moves, they've bought themselves like 6 months to a year's worth of rate hikes up front. So they don't need as inflation comes down, they can now fight inflation with 25 basis point hikes as long as inflation is declining.
Okay,
Okay.
right. So
Right.
like
Because
like smaller hikes are more powerful now at these
right.
levels.
Because here's a good example. Let's say we got up to 491, 500 basis points. We'll call it 500 basis points. Four rate hikes of 25 basis points over 4 meetings. We're at 6% now. We're just at where the year over year inflation is right now. Right.
Right.
The Fed in over 4 meetings, they can get and obviously what everyone also isn't understanding is will have base effects. It will have a base effect drag to the whole equation, right? Because as we go from in every new month, we'll remove the old, now they this is a little bit more complicated because the Fed the government has changed the way that they are measuring inflation into they're removing the 2-year lag or whatnot. But long story short, every new data point that's added, it's rolling, right? It's a rolling rate of change. So if inflation just stays if the CPI index stays where it is right now, inflation on a rate or change basis will flatline, meaning it will come down over time organically, because that's the base effect of the whole inflationary equation.
Right.
So if that is the case, which is likely going to happen at some point, there's a reason why inflation doesn't just stay pinned at 8% indefinitely, right? It goes in waves because it's cyclical, right? The CPI index will spike and it can go up very slow. Like, we can still have inflation very slow, but the CPI index on a year-over-year change will start falling off a cliff. It won't go negative, but it can go way down to 1-2%. Mm-hmm. Now, the problem is that type of flowing based off of all this money printing and stuff like that, it's going to be very hard to see, and we're going to have to see when and how that it strikes in that manner. But long story short, to keep this really simple and to keep everyone's heads screwed on the right way, the Fed can bring the rates up to 5%. Okay? Now they can manage them with smaller rate hikes, play the long game, and watch what the bond market's doing. I don't think the Fed is going to start cutting rates this year unless something tragic happens. We have positive GDP prints. We have all this low jobs. The Fed's going to want to keep hiking, okay? Because just remember this too. They're buying themselves time if they can. The more they can hike now, the easier it is to cut later and potentially not go back to zero, potentially. But we'll see. Maybe they do. Maybe they have to go back to zero. But every time they hike is another rate cut, if you think about it, right?
Yeah, it gives them more bullets to fight when they need it.
Right. Now, obviously, they can print money in this whole thing, right? There's a whole bunch of a plethora of options they can do, but it's really just the rate cutting. That it's not just rate cutting, but we're talking from a rate cut perspective. That's very powerful for them. And if they have to ease the markets, they're not going to ease a stimulated economy, right? So that's why they're not going to cut rates if the economy is rebounding. And if the idea of a soft landing comes in, the Fed is not going to just take away their ammo unless they really see fit. This is the whole problem with the Fed. The Fed is delayed, right? They act when they believe it's in their best interest to take advantage of the moves that they have in front of them. So if you think about it like this, we'll dumb it down real simple. The Fed could have hiked rates all of this 2021 bull market, right? When the market really took off at the end of June 2020 and went all the way to 2021, the Fed could have incrementally hiked rates. Why didn't they? Because they didn't have to. It was easy money. They didn't have to. It would have been inconvenient. The Fed will only act when they have to. The Fed doesn't have to cut rates. They'll act when they have to. Now, you can say like, oh yeah, the Fed's going to try and manage the risk of basically over tightening the economy into a recession. Yeah, but like the problem is the recession will hit before the Fed will, the yield curve will revert. The recession will hit and the Fed will be like, oh shit, I got to start cutting. That's what's going to end. That's what I think is going to end up happening. But until we get that whole recessionary play kick in, it's all about managing what's in front of us now. And we can go on about theories about where the Fed funds curve is going to go. I can just tell you that they're going to want to make sure 1980 does not happen again, because we literally printed 20% of the US dollar in the US dollar circulation during COVID. Okay, you can talk about your durable goods orders. You can talk about whatever orders you want or metrics you want to talk about, like, oh, this is good and the economy's doing okay. At the end of the day, you cannot defy the laws of economics. Okay, you print 20% of the currency, shit's gonna hit the fan at some point.
Yeah, now it might not be 20% of the currency. Everything's gonna become 20% more expensive.
Yeah, pretty much what we've seen. Yeah, right, exactly. So at the end of the day, the Fed understands this to some degree. They might not voice it, but they're not idiots. Okay, they know what's going on. It's simple. Unfortunately, I think they're going to hold rates and they're going to lift the back end of the Fed funds curve up into the end of the year. We'll see if that, as the meetings progress, we'll see what Powell says next week. We'll talk more about that in the FOMC video next week. But long story short, the Fed would rather go meeting by say that all I have to say is this in the next FOMC meeting. We're going to go meeting by meeting. We're going to manage it with smaller hikes, and we're going to combat inflation. We're going to try and combat inflation. They have to just say that. Is that hawkish? Sure, but based on the way the market's moving, everyone's expecting Powell to come out and swing his hammer so loud that everyone's going to run to the hills. He doesn't have to. They're at 5% right now. Historically, once we get up into these high inflationary numbers, the Fed is going to want the rate of inflation to come below the Fed funds rate to really signal that peak of inflation, right? That the idea that, okay, we got inflation under control. It's like that confirmation. Okay, it's come below. We regain control. When that happens, simply put, if we're at 5%, inflation only has to come down, another 1.7%, a little under 2%. For the Fed to really feel confident. And then the rate hikes just go all down the drain. Then now it's just holding strong until inflation really gets down.
Until something breaks.
Until they get, see, the thing is like inflation is like a waterfall, right? Like they want to get to their neutral target to whatever it is, right? Their neutral target. Whenever inflation gets down there, they'll want to ease the market to like prevent an over tightening. The problem is it all builds up and then cracks all at once, right? It builds up all slow and then cracks all at once. And it's like very hard. It's very hard to manage an economy when what you're doing is delayed by nature. It's not like the Fed's hiking right now and like, okay, we're going to see this. We're going to see how we're treating markets in the next month, right? So again, we'll finish this podcast off with this. Fed rate hikes are delayed by nature. We just did 400 plus basis points in under a year. How delayed do you think that's going to go? How long do you think it's going to take for this really to hit the economy?
Mm-hmm. Yeah. And
right?
When we start seeing that hitting the economy, they're going to wait for the economy to get hit, and then they're going to cut.
Right. Or at least the bond market's going to wait until it's confident the economy's going to, right? The bond market will front run, the yield curve reversion will front run the recession. So when the yield curve reverts, the bond market's like, yeah, something's about to hit the fan here. And it's very confident. When you see the 2s and 10s really revert, you're like, all right, something's about to go down. And most likely by then we have a solid risk off trigger. Okay. And we're getting ready to long bonds. So let's wrap that up here though. You guys will get another video early next week about the FOMC and then one about the jobs numbers. So I hope you guys enjoyed. Thank you so much for listening. If you have any questions, reach out to us in our Discord. Thanks, guys.